Am I audible? Am I audible? No. How will I become audible? How will I become audible? If I connect. So are you connected with us? Where? Physically, on LinkedIn, on our portal, where you are connected? Physically. So let's connect digitally also, because a lot of learning is there on the table.
Let's give a big round of applause to CA Rajiv Hira, where he's going to take us to deep dive into the heart of what brought us here, which is corporate tax, of course. Join me in welcoming him because he's seen not just the evolution of finance across continents, but helped shape it. He's worked across Asia, Africa, and the Middle East, has over 25 years of experience in taxation, compliance, and risk management. He's a go-to expert for indirect tax and AML CTF advisory. He's also the managing partner of FintEdu, an educator at heart, passionate about demystifying tax for businesses and professionals. In fact, he's done so many numbers of workshops with Tally. He's done radio shows with us at Talk Compliance, at SME Essentials. So big round of applause. You're gonna meet a personality you're never gonna forget about. Come on.
Accounting, taxation, compliance, what? Taxation? Can we discuss taxation without accounting? Can we discuss accounting without compliance? No. So boss tell you, see, I have this much profit, but I don't want to pay taxes. So what do you do? What you will do? What you will do? I need a participation from the audience which are in the room, and on the live they will have many answers with them also. So if you have to look at taxation, accounting and compliance, they all are sitting together. They don't sit aside. As you saw 3 people signing for this interview, similarly those 3 people sit together to look at accounting and taxation. Why taxes came to UAE or any part of the world? Why do we need taxes? Government? Revenue? Government revenue you are seeing? Yes, no, maybe. You have to participate. Why government need revenue? But you paid salary when you came, right? You already paid your due taxes. Why you need the revenue? Why government needs the revenue to run this country? UAE was anyway running before also without taxes. Right? What is the need? Better infrastructure, few salary gates will help us get a better infrastructure, right? So I think the objective we need to understand why taxes came to this part of the world. In fact, in a lot of countries, taxes don't came just for collecting the revenue. It came to legalize the things. It came to regularize the thing and bring the compliance on the table. When I say compliance on the table, why it is important to understand from where you are transferring the money from the bank account. Is it important? Yes, no? Yes. Why is it important? Anyone can raise hand and you can answer the question also. I think Kriyesh has missed one thing. We are going to give a participation certificate for this event. But 10 people will get a participation certificate in this room itself. But those people will be who will participate more in the discussion point. Am I right, Kriyesh? Yes. Perfect. So 10 people will get a certificate. So let's see who earns the certificate. So that's a kind of motivation we want to give. So when UAE government or any other government looked at why money is coming in and why money is going out, is this right money? When I say right money, we are talking about legal money. Or it has a problem, the way money is being moving. To regularize that, UAE government was working tirelessly to bring up the structure since last few years. So a lot of people believe corporate tax came in 23, but I keep demystifying, saying that no, it never came in 23. It started way back. The journey was there since 2017 itself. However, as a structured corporate tax came in 2023, which we can say. A lot of countries are already having corporate tax. So what is the difference from a UAE perspective? What is the tax rate? 9%? Single digit? Right? Any other country has single digit tax rate, which you know. Keep one or two out, which are there. In the countries where we know, they are double digit. Yes. And that too more than 30% or 40% in some cases also. So 9% is it to be worried about? I'm just giving a perspective to you. Government is not having an intention only to collect the funds. Yes, it's a byproduct, and we love the byproduct also. But the main objective is compliance. So that is where the corporate tax understanding has to be brought into. It is not about money. It is not about money. It is how that money is being transferred, how that money is being earned. That is becoming a goal. So let's look at some of the points which came up. At an international level, there is a OECD framework which looks at how those countries or how those other countries are managing the black money versus white money versus green money versus blue money. I don't know how many colors are there, but we broadly know few colors, right? So they said these are 15 action plans which you all need to follow. Out of these 15 action plans, you all can see. Is it proper? Okay. So if you see, there are a few actions which are very important from a tax perspective. Couple of actions which are being defined are harmful tax practices. They don't want any kind of a tax practices which allows people to shift their money from a high tax jurisdiction to low tax jurisdiction. Since maximum of you were working in the finance field and accounting field, we have seen ESR, economic substance regulation. How many of you know economic substance regulation? You know that. Under economic substance regulation, there are few people know, so I will just give a quick background. UAE government or across the globe, they started looking at the countries which are either zero tax or low tax, and how people are shifting their profits from a high tax country to zero tax country. What people used to do, you have a company, and the company is a shell company. What is the meaning of shell company? Shell company means only on the paper. That means no office, maybe, no people who are managing, or if people are there, they're managing from somewhere else, not in the country. They said, hold on, we don't want this. We want people to have substance. Substance means have some value in what you are running. So how you brought up this substance? You started evaluating few points. You said, the company should have at least some square feet of office, right? Some people, some assets. Now the word which is used is which is commensurate to run the business. They are not told how many people you need. 1, 2, 4, 5. No one has said that in anywhere in the law. They said what you need. Do you have that number of people to run the business what you are running? Correct? A lot of people discuss with me saying that I have a company and I have one staff and I do X value of turnover. I said I don't need to know the value. You give me the theoretical questions and answers. How many invoices you are making per day? Right? If I ask that question, I will know how much efforts are required to prepare that invoice. Am I right? If you are making 10 invoices in a day, can it be managed by one person? Yes or no? Maybe. I will use the word why. Because yes, if it is a service, I have intellectual property, I'm just invoicing for royalty charge. But if it is a trade transaction, where I have to create the full document when I am doing a transaction, that means I need a BL copy, I need insurance copy, I need packing list, I need invoice, I need further 5-10 documents which are attached to it. Can one person make 10 documents in one day in those cases? May not be. So then we start putting a question. If you are not doing this activity in UAE, then where are you doing? And suddenly used to question, used to answer, used to come. No, our team which is sitting in home country does that. That's a problem. And that's a problem which is bringing up the story. So why you are making invoicing from UAE when the support team is sitting in your home country? That means you are trying to shift the profit from the home country to UAE. That is the only objective. If that's the only objective, UAE government said, sorry, we don't want those businesses. If you do that, we are going to first look at your substance non-compliance, put up fines, and in some cases we will report to your home country also, saying that this gentleman or this company or this organization or this lady is shifting the profits from home country to UAE. Are you clear? So what we started doing is, we have started doing it compliance. UAE was not gaining any taxes in the process. Since we are just reporting, are you collecting any taxes? No. During non-substance regulation phase. Were we penalizing anything to people? Yes, we were penalizing from a regulation perspective, but only cases where people don't have substance. So these all framework came from OECD, which says that we need to follow this framework. And then came a very interesting story, which says large companies, which has more than 750 billion euro of turnover, they were shifting the profits. So they brought up those companies, they said, we are going to put up minimum taxes to you, which are going to be 15%, not 9% also. But that regulation is still not enacted. So this is more theoretical right now. But there is an action which is already in place for larger organizations. If you are having your structures in various countries and you are trying to evade taxes, we are going to charge you 50%. So this is also one of the framework for large organizations which has come up. Now this is what I said. When we say corporate tax has come up in 23, which is not a right statement to mention, because corporate tax has come up way back. How many of you know what is FinTax? UAE got FinTax in 2017. What is FinTax? What is? Perfect. What is the meaning of sin? Sin means wrongdoing, right? So they said people don't smoke, people are not listening. They said people don't drink too much sugary drink, you are not listening. They told people don't drink the soda or carbonated drinks, you did not listen. They said it's not good for health. We are putting up a sin tax on that, which ranges from 50% to 100% also. So that is what generally we call it excise tax in UAE. But the Arabic terminology is sin tax. So in the sin tax, they brought up a lot of products in the tax frame. If you are going to drink, drink, but please give us money to create hospitals for you, because you are not listening us. We told you not to smoke, you are smoking. We told you not to drink too much sugar, you are drinking. We told you not to drink too much soda, you are drinking. Okay, give us money so that we can use that money for your treatment when it is required. So that is the logic of sin tax. Then came the value added tax in 2018, where a lot of accounting people got into UAE framework and they said, now we are not going to tell my owners how much balance we have to receive and how much we have to pay, but we have to do some accounting also. Till 2018, if someone was there as an accountant in UAE, the only question which owners used to ask is, can you give me a receivable and payable position and tell me how much balance is in the bank? Am I right? Anything more at that time? Did anyone ask even balance sheet P&L also? A lot of time, no. But VAT brought up a story where they said, no, now we want you to reconcile the top line. Are you with me? The moment VAT came, had you started doing reconciliation of top line? That means revenue. We started. If you are not doing, then please do it. Because that's the most important part from a VAT perspective, where your sales gets reconciled. You are looking at my total sales as per balance sheet. Then you look at from a VAT return perspective, taxable 5%, taxable 0%, export, and out of scope and exempt. You have to classify in all these 5 sections. If you are not able to do, please start doing it immediately, because that's where we have seen any audit from a VAT perspective when comes. This is the starting point. The first question they ask is, can you reconcile the revenue with the VAT return, because that's a mandatory requirement. In corporate tax, what we do we reconcile all the statements or not? So sales started getting reconciled here. And second thing, your output becomes an input of someone else. Am I right? If I sell, I charge VAT, someone else is going to claim that VAT. So that means there is a reconciliation happening between traders also. You cannot manipulate your numbers as per your wills and fancies. Before 2018, even at the end of the financial year when you have to prepare the balance sheet for banks, the sales number could have been adjusted. Okay, what is the sales I have to show? 1.2 million. Sir, if I show 1.2 million, banks are not going to agree. Okay, 12 million. Because there was no reconciliation till that time, there was no verification unless you are importer of the goods. Unless custom was the part of it, there was no reconciliation. You have to just show you have purchased the goods in cash or paid in cash. Invoices has no regulatory meaning. There was no VAT number. There was no tally which was happening. So that is where it comes into. Going further, FT authorities have noticed that there can be issues on the gaps between invoice issued and invoice claimed. In global terminology, we talk about missing trade fraud in VAT. Missing trade fraud means I went and claimed an input tax, whereas you have never issued the invoice to me. Where is the situation for FTA right now to reconcile that? Yes, they do sample basis, they verify, but there is no structured reconciliation. That's why they are bringing up a terminology or concept which is called e-invoicing. That will be applicable in a year from now, where all your details which you are issuing invoices will be uploaded in the FTA portal. And on the other side, if you are claiming input tax, you can claim input tax only what is already uploaded. If you have an issue, go and correct from your supplier. How many of you see TDS returns in India? You have seen TDS return? Is there a reconciliation now? Initially, I remember you used to have forms. We need to attach the forms, bring up the TDS certificate, show it to tax authorities. Is that process there right now? Yes, no, maybe? So right now what happens? The deductor will deposit the TDS and I can claim TDS only what is credited in my account. Similar thing is going to happen from the invoicing perspective also. So the economy and the world, and specifically UAE, is getting into a automation or digitalization mode, where if you issue invoice, then only the person is going to claim the input tax. So that's going to come in the structured way. They are not going to bring up for everyone, maybe high value transactions before, and then slowly it will gap up into a lot of activity. So this is where we say VAT has brought up the reconciliation on the top line, which we'll see from a corporate tax perspective why it is important. Then UAE became part of a BEPS framework, 116th country. BEPS is base erosion profit shifting. Simple English, if you shift your profit from one country which is a high tax country to low tax country, that is where they want to catch up those actions. And it is not about only we joined and signed. We also agreed that we are going to keep sharing the information between the countries. So that means if you do any investment in UAE, please expect that that detail will be available in your home country. Making sense? If you have any investment more than $50,000 in UAE, that will be reported to your home country, subject to the home country has signed off the BEPS framework, and we were 116th and there are further countries which have signed off. So almost 95% of the global GDP have signed off this document, and they are sharing the data with each other. If a person buys a property in UAE, his passport is attached to the property? Yes, no? So the home country will know that this gentleman has purchased the property. So there is no evasion on that part possible. Maybe authorities are not interested to look at that data right now, which is fine. But when they want to, do they have that data available? Answer is yes. So whenever we are looking at compliance, we need to look at these frameworks also. Next came AML CFT framework, anti-money laundering and countering the terrorism financing. So this is where again the section has brought what money you are receiving in bank, what money you are paying out the bank, everything is being reconciled and tracked into from a transaction perspective. How many times you send a payment to a supplier or receive a payment from the customer, the bank asks you, can you share the details? You can shift it. So can you share the details, right? They will ask you, give me the shipping documents, give me the bill of lading documents, give me the invoices, to whom you are paying, who are the beneficial recipient of that. Am I right? So this is also becoming part of a taxation framework only, and I'll tell you why. Further, there is an action came which is CBCR requirement, which is country by country reporting. If you have a company in multiple countries, you have to report country wise how much sales, how much profit, how much turnover we are making in respective countries and how much taxes we are paying. So this also brought up into the tax framework. Are you paying too much of the profit moving into the country where there are no taxes or zero taxes or negligible taxes, or how are the turnovers are moving in? So all the large corporates which you keep listening from, where they have companies in zero tax countries, that is where they brought up those section on CBCR. Then came economic substance regulation, we talked about that. So this is again to look at how the substance is being maintained. Then comes the beneficial owner register. Why BO register is important? Beneficial ownership, why it is important? Why beneficial ownership is important? Yes. Everyone is saying yes. Why it is important? If we issue a certificate to you in your name, should I check your Emirates ID? Yes, no? Yes. Why should I check? To establish that you are the person in whose name I am writing a certificate. It is not going to any third party. There is something called Benami property. What is Benami property? Buying property in someone else's name who may not have a vested interest or may not have a worth to buy that property. So they brought up the section of beneficial ownership where they said whoever is the owner of the company has to be clearly articulated. And it's not only owner, a beneficial owner, the word is. How the beneficial owner is different than owner? I am running a company, I have only 10,000 capital, right? And this gentleman came to me, he said, Rajiv, why don't you invest my money and run the company? Whatever profit comes, slowly give me back. I said, no problem. He said, okay, take 10 million dirhams from me and run the company. My capital is how much? 10,000. His capital? 10 million. Technically for the business, who is a beneficial owner? Me or he? I am the owner, but beneficial owner who is? It shifts out. That is also important from a corporate tax perspective to understand who is paying taxes on for whom he is paying taxes. Is there a power of attorney he has taken saying that I will run the company, but you become a manager and do a front ending? So these are the things which has to be identified as a beneficial owner. And then came a corporate tax, and corporate tax said, enough, you have done a homework. Now I want you to file a full corporate tax return. Now when you are filing a full corporate tax return, it's not only top line, you are reconciling your expenses also. What are you paying, to whom you are paying, everything will come into picture. A lot of time we keep listening that I am paying a referral fees to someone. Can I pay it? Example, I am a HNI category of a individual. I keep moving with a lot of people who are high net worth. They have large money. So what happened? One of my friend who is running a broking firm in UAE, he said, Rajiv, why don't you refer your clients to me or your friends to me? If they sell a property, if they buy a property from me, then I will give a referral income to you. Is it okay? I am referring. They are giving income to me, right? But I am working as an employee in some organization. Is it okay for me to receive that referral income? Yes, no, maybe. I'll tell you, referral income is 5 million. 5 million dirham referral income I am receiving because he has sold some villa of 100 million to a client who was referred by me. Is it okay? If it's the same kind of business, no. I am working as an employee in a government organization or multinational organization, and this is only because of influence I was able to connect them, and he is issuing a check of 5 million to me. Two questions. Point number one, what is my obligation of receiving this referral income? Is it business? Is it business? No? Yes? It's not a business? 5 million, okay, I earned like that only. Not a business. Very good. Second question, will the broking firm be able to take a deduction of this 5 million as an expense? Yes? Had I issued an invoice to them? First question. No, I have not issued, right? Am I required to issue an invoice which is VAT compliant? How much threshold is there for VAT? 375,000. So if 375,000 is breached, am I required to charge VAT to him? So had I issued a legitimate invoice is the first question I am asking. Had I issued a legitimate invoice to the company? If no, then how can they claim deduction? So you can see the loop, how it is coming up. How many things are non-compliant here? Can I do a business without a license in UAE?
No.
Of this also, of referral also?
No.
Am I allowed to? No. Very strong answer, no. Perfect. I strongly believe this is the right answer. So I am doing multiple things which are not correct in this process. A small step, I don't have a permission to do a business. I may require a NOC from my employer also to do this activity, which I have not taken. I am required to register from a VAT perspective, which I may not have done. I am required to register for a corporate tax also because my income is beyond 1 million. Are these not non-compliant? Yes, no, maybe? They are non-compliant. Now, look at from a company which has given the commission, they will not be able to get a deduction because the invoice is not a legitimate invoice. Are you with me? So many non-compliance in a small transaction. So everything comes as part of it, what we are talking about. So VAT gets connected with a corporate tax. Beneficial ownership gets connected with a corporate tax. Any compliance of AML gets connected with a corporate tax. Now the gentleman said, why we are doing bank transaction? 5 million come in a normal suitcase, right? So give it to me. Is it okay? What section I will breach? You may breach the AML framework somewhere, anti-money laundering framework somewhere, right? So this is where this slide is very important to understand. When we are looking at corporate tax, don't look at the tax which need to be paid. We need to first look at the compliance. If compliance is right, taxes are by default going to be right. Are you with me? Important slide or no? Important. Now one more question which came in some of the discussion. There is a hospital, correct? Over there, doctor comes on a visit. The doctor has his own clinic or he is working on some other hospital already. He comes on a visit to another hospital, does a treatment and takes a fees. And he refers some test also, and the test center issues a check to the doctor as a referral. Are you with me? As a referral. So is it okay? It's okay? Point number one, not okay. How? Let's break down. Doctors are not allowed to take referral from any centers where they refer from the test perspective, against the health authority directions. First. Two, he is an employee in an organization, right? If I am paying a fees to him, he should or she should be a professional. Do they have a professional license to operate like that? Are you with me? Are they employee? No. They are employee somewhere else. But the other hospital is paying not under the employee capacity. If you are not paying under the employee capacity, under what capacity you are paying? As a business and profession? Are you with me? I am an employee of hospital A. Under hospital B, when I go and visit, I get a fees. Under what capacity I am receiving that fees? As an employee relationship or a professional relationship? Professional relationship. If it's a professional relationship, am I required to have further licensing activities and required to register from a corporate tax and VAT perspective or no? Are you with me again? So small aspects. Am I talking any rocket science right now? Exactly what we face on day-to-day basis. Who is going to ask those doctors, professionals, real estate, referral partners on how fees has to be shared or paid? There are few incomes which are exempt for individual, we are going to talk about, but those are few and those are very specific conditions and we are going to look at those conditions also. Let's move further. So UAE authority has said we will follow the corporate tax in a very simple way, but we will make sure that all these things are there in the corporate tax regime. First, transparency. We want to be transparent, how we are going to calculate tax, what are the regulations, what are the laws. It's not that I will tell this table something different and you different. We are transparent in the structure. Second, they said we want you and us to make a trail. Trail means audit trail. Verify the transaction. This is where e-invoicing is also part of it. When you are trying to make a trail, you are want to see the transaction from the end. That's a very important part, and keep understanding that if you are taking a benefit somewhere, someone else should be giving up that benefit. If you are counting something as your income, it should be an expense with someone else. That's an audit trail we are talking about. We are talking about governance ecosystem. There will be enough governance ecosystem where tax authorities are going to verify the data, what you are going to submit, they are going to evaluate, everything is going to happen. And the last two are important, which is search and seizure. What is search and seizure? They have a right to search in your premises, on your laptop, on the data, on the information which you are sharing amongst each other also. So if you are writing an email or your boss is writing an email to you, why you are paying so much taxes, find the way. Is it okay to get caught in that information? A lot of people are smiling because they have seen those emails. So when you are looking at the information has to be sacrosanct from an end-to-end basis. You need to be very clear how you are documenting, because that will become an audit trail for you. That is going to be in favor of you or against you when it is read in the future. So it's not only a communication which you are doing, it's an important communication which you are doing. If I'm claiming some expenses, the trail or the document has to be very clearly articulated. Why we are claiming it, what is the justification, why we are considering it to be a business expense, all those details has to be very clearly documented either in the emails or on the text, whatever method you use. We are not going to guide you on how you use it. If you are creating a voucher, how will you say the coffee your owner had with someone else is for the purpose of business or personal trip? How will you define that? Correct. So who will write the purpose? That's it. You or the person who has visited, you need to tell them, I need to understand the purpose also. I'm having a coffee in the 5-star hotel. Is it for business purpose or non-business purpose? Most probably possible. I am running a laundry shop, a normal laundry shop in the colony, and I take my clients to the 5-star hotel. He changed the stand immediately. So we have to look at a logic also. I am handing a client who is going to buy maybe rice of 2 million tons from me, or on a value basis, let's say 10 million value of rice from me, and I am treating them into the 5-star hotel with a coffee and a normal lunch and having a meeting. Can this be a business purpose? Can be. So look at a justification. See, only the statement where the coffee had is not the right statement to say whether this is personal or not personal. right? A Mercedes is being used to pick up my guest from the airport to the hotel. Can it be a business?
Yes.
It can be, because I'm getting some suppliers from the foreign country and I'm greeting them to the location. But if they are my wife's side, my wife, brother or someone is coming, business purpose or of personal purpose? It's a business personal purpose. Otherwise my wife will kill me. I may not claim taxes on that, but it is an important purpose, but not, you cannot claim it as a business purpose. So when we look at this transaction, in all the situations, one aspect may have a different meaning, right? You need to identify it, document it. That's the most important thing which comes into play. A lot of time we have the invoices, but after 15 days or 1 month when you open the invoice, we don't know what happened. So start writing narrations, which not only you, maybe whoever comes after you also should be able to read and understand what was the purpose of the transaction. This is where it comes. From a corporate tax coverage perspective, UAE had some level of taxes under the corporate framework also before, but which was limited to respective emirates. Now it has brought up at a federal level. Federal means at a country level. So 2 taxes were there predominantly. Two taxes were there predominantly. One tax was on foreign banks having a branch in UAE, and second was extractive industry when they have a presence in UAE. Otherwise, it was no tax from a corporate perspective, and this is where it comes. This is where it comes. So 2 structures were there, and which was changed now. UAE has already given a tax holiday to a lot of free zones. Do you know the difference of free zone and mainland? What is the difference? Free zone?
You have 100% ownership, but in mainland you cannot.
You can have now. So the story changed for a few years back. Now you can have 100% ownership in mainland also. That was there, you are right, but it has changed in last few years. What is the other difference? For VAT. So free zone to free zone, there are no VAT which is applicable. Is it right? You are right, partially, we'll rectify that. Any other point? Qualified and non-qualified income from a free zone perspective. See that no VAT is on designated zones, which is also a free zone. But why there is no VAT on designated zone? Why? Why you want to give special rule to free zone? Free zone is also part of the UAE framework. First question is why we created free zones? Why UAE has so many free zones? For boosting the international trade. That's a beautiful and the right answer. See, any economy, if you see is growing, will grow only when they have what? Forex positive or Forex negative? Any economy which is on the growth path is always Forex positive or Forex negative? Forex positive. When will get a Forex positive? When we export or when we import? Export. So when I am exporting, I am getting Forex. So UAE also wants to promote the economy where we have Forex inflow. So, and these free zones were created to manage that. They said, although these free zones are within the UAE, we will treat it as outside UAE for tax purpose. For tax purpose. Subject to, there are certain conditions. You should not have paid the custom duty. You imported the goods, but meant for either export out or process and then export out. So you are not meant to pay the custom duty. The moment you pay custom duty, that means goods are ready for UAE consumption. And the moment it becomes a UAE consumption, you are subjected to tax, although you are in the free zone or designated zone. So that's an important part which you need to look at. From a service perspective, there is no benefit for a free zone. From a service perspective, no benefit from the free zone side on VAT. Any transaction which you do on a service side, you will treat it as in parallel with what you do in the mainland. So these are the important factors you need to look at. From a tax perspective, there is a tax holiday being provided. Now this tax holiday is for 50 years, somewhere it says 45 years, somewhere says. But UAE government said, hold on, we are rectifying that. We'll come back exactly on till what period, which free zone will have a tax holiday. So right now, corporate tax covers those framework, VAT covers those framework, but till what period, we may come to know very soon, but right now, you can treat those free zones as taking the benefit from a tax perspective. UAE corporate tax is basically a profit, it's a tax on business profit or business income. I'll give one simple storyline. So this is where the taxes start and this is where the framework comes into play. Let the presentation be here. I'll just give one statement and one situation. You have to tell me whether this is a business income or not. Today morning I was sitting and looking at online portal for buying a car. Are you with me? I opened a portal for buying a car. Suddenly I saw a Ferrari supermodel only for 1 million. Second hand Ferrari, 1 million cost. I liked it. I said, let me buy this immediately. What I did, I blocked that vehicle and I called the gentleman. I am going to buy this Ferrari for 1 million dirham. He said, no problem, transfer 50,000 to me. I'll block it for next 2-3 days. If the whole money comes and we transfer, fine. Otherwise, 50,000 write off. Correct? I did that. And next day, I was showing those picture of Ferrari to one of my friend. I said, I am going to buy this Ferrari, you know. He said, wow, that's a vintage Ferrari, not even Ferrari only. So he said, why don't you sell it to me? I said, why? I've not even tried, I've not even driven, I've not even sat on the seat. Why should I sell you? He said, Rajiv, 2.1 million. I'm going to pay 2.1 million to you. Are you ready to sell? So what should I say? Done. 1.1 million profit in one day, what more you want? I did the transaction. Next day, we all 3 people, me, the seller and the buyer, we went to RTA, we got the vehicle transferred. Are you with me? Yes. We got the vehicle transferred, and when the vehicle got transferred, in my pocket how much money was there? 1.1 million adjusted with 50,000 advance. The seller got how much? 1 million. And the buyer paid how much? 2.1 million. You are with me on the number? Oh, perfect. Rewind back. I'll change the situation. Same day morning I was sitting, I was just scanning, I found the vehicle Ferrari 1 million, I paid 50,000. I'm going fast so that you know the transaction. But next day what I did, I called the seller and we went to RTA. We got the vehicle transferred in my name. I paid him 1 million, correct? And vehicle is with me. And I was driving Ferrari on that day. And I said, let me show off to a couple of my friends. So the same friend, I went and shown off his vehicle. I said, come, let's go for a tea. He said, fine. In a Ferrari, which tea? He said, Karama Tapri shop. So tea will be for 2-3 dirhams only. So we went, had a tea. And during that time, he said, Rajiv, why don't you sell the vehicle? Situation little changed, right? So in this case, now I am the owner in the RTA. And we agreed 2.1 million. We went to RTA, got the transaction completed. In net, same value-wise proposition. Value-wise proposition same. Did I did a business in the situation 1 or situation 2? Situation 2 I did business or in situation 1? Change of ownership was there in situation 2. In situation 2, I have an argument that I have taken the possession of the vehicle and it was my personal vehicle. In situation 2, I had taken a possession of the vehicle. You remember I got a RTA transferred. In the situation 1, I have not got the RTA transferred. Correct? Situation 1 is by default a business. Because I received what? Commission. Profit. In situation 2, also I received the same money. But the situation got changed because that became my personal effect. My personal asset. You can see the difference in both. So if you sell your personal car, Is it going to be taxable under corporate tax? Personal car. From this perspective, no. But if you get a commission or incentive in between, is this going to be taxed? Yes. So that's a difference between how the business income is to be looked into. When you look at a transaction, don't look at what value. A lot of people get diluted with a value. Oh, it's a small value, it's okay. No. First, identify whether this is business or no. If it is business and consolidated is more than 1 million, welcome to the world of corporate tax for individuals also. Right? Because why I took that value, in this case 1.1 million, which is more than 1 million, and for individuals, anyone who earns more than 1 million business income is subjected to tax. Look at the framework from the taxation framework, not the otherwise. Are you with me? Are we gelling well? Are we connected well? Similarly, if I do something so coming back to how this framework has been brought up into, from a corporate tax regime perspective, UAE authority said 2 things we want to ensure that corporate tax takes care of. One is tax transparency and preventing harmful tax practices. Harmful tax practices, we talked about base erosion, profit shifting, all those things UAE authorities are not comfortable with. So in case any transaction which is happening between 2 parties, you need to look at, is there a tax evasion? Is there a process where people are undercutting the prices or overcharging the prices? Both has to be looked into effectively. So tax regime came on 1st June 23. A very simple thing. If you see, I'm sure this is known to everyone now. Any tax period which is started after 1st June 23, your tax accounting has to be looked into, or financial year has to be looked into that way. From a UAE perspective, can I have different tax calendar year? Different tax year, right? In our home country, generally these are fixed. But in UAE, they said, whatever you want. So they made us busy for the whole year. Some companies have a tax year from Jan to December, some have from April to March, some have even June also, starting period. So various calendar years are there. Please follow what the calendar year is being followed in the, how you will find that financial year. How you will find the financial year, what is the financial year for your company? VAT registration, no. Your MOA. If your MOA does not have the calendar year, which is a financial year, then you need to go and ask your authority, registration authority, for the calendar year. Mainland, if you don't have a calendar year mentioned in a MOA, they had declared the by default calendar year will be financial year, which is Jan to December. So maximum companies are covered under Jan to December, but you need to follow your MOA. In some free zones, they mention very clearly. If they are not mentioned, please go back and ask them. It's too late. If you are not done so far, 10,000 is anyway sitting on the penalty for that purpose. Correct? So 10,000 is already done for this to start with. So UAE has very interesting tax framework for general people and for free zone. That's how it is broken into. For general category of companies, the tax has a slab. That is up to 375,000, 0% tax. Beyond that, 9%. But for free zone, something very interesting, there are only 2 categories, qualifying income, non-qualifying income. If you are into the qualifying income category, you pay 0 tax. If you are a non-qualifying, you pay 9% taxes. That's how the breakup is. There is no threshold for free zone companies. There is no threshold. If in one of the year, your total income is under the non-qualifying category, you get taxed at 9% without a threshold. That means no threshold of 375,000. Are you with me? So for normal companies or companies which are taking a benefit of normal category, not getting a benefit from a free zone perspective, you end up paying slab tax, 0% tax up to 375,000, beyond 375, you pay 9% taxes. But for free zone, there is no category. Qualifying, non-qualifying. We're going to talk about this post-lunch. on quite a detail on a free zone perspective also. So UAE, they got a very simple thing for individuals. They said 3 incomes, we are not going to tax you for individuals. So there is always a myth saying that for individuals there is no taxes. No, that's not right. Only 3 incomes are exempt from a tax perspective. Everything else is taxed. First, anything which you receive as employment income. What is employment income? Salaries, which are registered somewhere with the labor department. Okay, you cannot pay salaries to anyone else. Example, I am a professional, I am running my consulting firm. I come to your organization, I say, pay me every month 10,000 and I'll be retainer for you. I'll come and sit in your office for a whole day. I'll work whole day and you pay 10,000 to me per month. What are you paying me? Professional fees or salary? Professional fees. It's not salary. Because I'm not employed by you. You have not issued a labor card to me. Right? Visa, possible, not possible is a different story. A lot of people have golden visa also. But the golden visa has to be attached with the employment contract. So a lot of organizations to start with we have seen, they said, we have employees which are on golden visa. I said, so what? You know, golden visa is not a permit for you to work. It's a permit for you to stay. For working, you need to do something more. Either you need to have an employment contract or a permanent, there are various free zones are calling a different terminology, but they give an employment contract equal. So if you have 4 visa quota in your company and one of the golden visa guy goes and takes a permit, that one number reduces and you will have an employment contract issued for that. So be careful on that part. This is only applicable if you have an employment contract and the income is in the nature of salary. Second, investment incomes are not taxable in the hands of UAE or individual. Any investment income is not taxable in hand of individual. What is the meaning of investment? Yeah? Getting benefit in return. I did a investment in shares. Is it investment income? I invested in the shares. Is it investment income? Yes, no, maybe. I purchased shares of a company which is registered and listed in ADGX, Abu Dhabi Stock Exchange, and I'm getting dividend income from there. I sold those shares after a couple of months, I get a capital gain. Are these investment income? Yes. This is fine. I do a day trading. A lot of people know day trading, right? That means I don't take delivery of those shares. Is this investment income? Day trading is not an investment income because you never got the shares in your custody account or a demat account. If the shares have not come into custody or demat account, it is not a investment income, it becomes a business income. Remember the example of RTA, the vehicle which we talked about? Over there also, if the possession is taken, I am taking a different stand. That means if RTA transfer has been done, I am taking a different stand. If RTA transfer is not done, I am taking a different stand. Similar thing will happen for investment also. If you have taken a delivery, it takes a different stand. If you have not taken a delivery, it takes a different stand. So be careful on classifying those incomes also. And this becomes interesting when you have those incomes which are more than 1 million on the top line. You are required to register from a corporate tax perspective also if you have those income. But we are not counting anything which is done outside UAE. We are only looking at what is done inside the UAE or from the UAE. We'll come to that framework also, how that is to be looked into. One thing which we'll get into, so if you see, these are some of the incomes which are not taxable from a UAE perspective. So anything to do with dividend investment, they're not taxed in UAE. Certain conditions has to be looked into. But there are certain cases where the exemption does not apply. Whom should we tax in UAE? Who are the people will be taxed in UAE? A friend of mine having a business in India, should I tax him in UAE? Why? Because he's not a taxable person. Who are the taxable person from a UAE perspective? Residents of UAE. Are you with me? Are you resident of UAE? So all will be taxed, right? Residents of UAE is not the only condition. I'll just go straight away to one pointer, we'll come back to that. So there are two categories of taxable person which comes into. One is a resident person. Who are a resident person? We'll just quickly look at this and we'll do a break after this immediately. A resident person can be someone who is incorporated in UAE, full stop. Any company which is registered in UAE is a resident person. Are you with me? Any company which is registered in UAE is a resident person and they are required to pay taxes in UAE. Jafza Offshore Company is a resident company in UAE. RAK Offshore is a resident person in UAE. Yes, no? So both answers are coming, yes and no. First don't look at the nomenclature. The nomenclature is incorrect. They are registered in Jafza under the category of an offshore company. That means they are not allowed to do business in UAE except for certain conditions. But are they registered in UAE? Yes, they are resident companies. The moment we say they are registered in UAE under the Jafza regulation, they are resident person in UAE. Hence, it will be a taxable person. So any company which is registered in UAE by default is a resident person and we have to calculate and look at the taxes for them. First, register them from a corporate tax perspective. Second category, if I have a company which is a foreign company, so Indian company, right? And all the shareholders, directors are sitting in UAE and managing the business of India from UAE. Where the control is, in UAE or outside? In UAE. Although you are registered in India, but you are controlling that company from UAE, it becomes a resident company from a tax perspective. So it's important to see where the decision makers are sitting. Are you with me? Who are the decision makers of a company? Directors. Directors are decision maker of the company. In some cases, you have a shareholder who are taking a role of director because maybe one or two people are there. But in that case, I will check who are the decision maker. Are shareholder the decision maker? That means they are acting as a shareholder and director. If they are acting as a shareholder and director, then also decision is in UAE. So anyone who is running a company in India and are conducting board meetings in UAE, you are also in a problem. So make sure board meetings are not conducted in UAE. So travel back to India, have board meetings and come back. UAE don't bring up that framework. Because the moment you control from UAE, you become a resident person. Now a lot of people say, how will they know? Correct? Am I right? How will they know? So all the filings you do in MCA in India or in whichever part of the world you are coming from, if any registration authority filing you are doing and you are signing the document and every document has a date, if those are matched, you have a trouble by any authority from a UAE perspective or India perspective or any other country which you are talking about. So make sure the decision making activity of a foreign company should not happen in UAE. If you are making it by an error, you are welcoming yourself to the UAE corporate tax. But one benefit, since the home country taxes are higher, you may not be paying taxes in UAE because you will get a benefit, but you are subject to all the compliances in UAE. That means you need to register, you need to file your return, you need to claim the benefit of taxes paid in India. You may not be taxed, but you will come into the compliance of UAE. So any country controls which you are done. So this is predominantly becoming a difficult situation for companies which are registered in Cayman Island, BVI, Jersey, where people are not traveling even. And all the decision makers are sitting in UAE, you are becoming a resident company. So that's where the important part. Third thing, we talked about any natural person which has a business income in or from UAE. Here we are not talking global income, we are only looking at income which is earned in UAE or from UAE. That if it crosses 1 million threshold, then you are subject to tax and you become a resident person. Are we clear? In this category, global income is taxable in UAE. If you are a UAE company, your global income is taxed in UAE, you may get a benefit of foreign taxes what you paid. The moment you become a controlling company of a foreign company, there also global income become taxable. But for natural person, it's not global income, only UAE income become taxable. So if you have any rental income or other incomes in home country, don't worry, it's not going to be taxed in UAE, because for natural person, only the income which is earned in UAE is subjected to tax. Are you all with me? So far we are going fine. Am I fast, slow? So how is it going so far? So just to give a perspective, very quick one. Under FintEdu title, we keep conducting a lot of workshops, so you can follow us on the LinkedIn or you can follow us the website itself. The moment you register yourself on the website, there are a lot of free content which is available. You can watch the videos. We keep doing Friday talks where we invite the experts. They will talk about the topics, which are 3 topics only we talk about: tax, accounting and compliance. We don't talk anything else. So these are the 3 things. If you are interested, you can register yourself. Friday, normally we have 5 o'clock session for 30 minutes and then 10 minutes we give for Q&A. Lot of people come on anti-money laundering framework, taxation framework, even cash flow, how to be done, what are the CFO roles which are there. It's interesting, half an hour while driving, while transiting from office to home also you can listen and you can watch, but it's a good thing to do. Happy to get attended on those parts. So coming back to, so you understood taxable person. There are 3 kind of taxable person which are resident. Now there is something which is interesting. We are taxing some non-resident also. Now where? How? If you or any organization comes and sits in UAE and does a business in UAE, then also we are going to tax them, although they are not in the 3 category, which is where it comes non-resident person are getting taxed. First is permanent establishment in the state. It's a very tricky statement, but very interesting. So if a company, example, is coming to UAE and helping the organization in UAE itself to do some business for a longer period of time, we tell that you have a permanent establishment in UAE. I'll give examples, you will have more clarity. Let's say I'm buying a software from a company which is in Far East, Europe or wherever. So I'm purchasing a software from them. I got a software in UAE. So when I purchase a software, is it an import of services for me? Yes, no, maybe? When I'm buying software from outside, is it an import of service? Right? Had this software crossed the custom boundary? So answer is 2 ways. Had I paid any custom duty on this? No, because it's a software, right? So that means from a VAT perspective, what action we need to take for this import? RCM, right answer. Reverse charge mechanism has to be looked into. Although we are talking about corporate tax, but I still keep touching the CT to connect the dots. So in this case, I will say I am providing services, I am receiving services from a foreign entity in UAE. Now this is so far it is fine. Now I said for having set up that software in my core accounting system or my core system, I need 4 to 5 engineers, software engineers to come in the country and do an implementation. Are you with me? Correct? Now this implementation is a long drawn implementation. That means those 5 or 6 people have to be in UAE for 7 months. I'm specifically using 7 months, which is more than 6 months, to identify whether they have a presence in UAE or not. The moment I go into this category, I am creating a permanent establishment for the foreign entity in UAE, and they are required to register in UAE from a corporate tax perspective. I'll give a pause here, get digested. Although this software company does not have a presence in UAE, but their team came from European country to UAE and they're sitting in my office. And while sitting in my office, they are doing implementation, coding, final setup, final API integration and all those
technical jargons, they are doing it for me for more than 6 months. This also create a permanent establishment. In that case also, they are required to register in UAE and pay the corporate tax.
So they came in a mission visa or a separate any visa?
They generally should come under the business sponsored visa.
So the company which won't buy the software,
Correct.
they will give the mission visa.
Correct.
So based on that one, the company which one based on the US, they will tax it.
Correct.
Like that.
Correct. So this is the category. If they come on a tourist visa and the authorities find them sitting and working in our office on a tourist visa, bigger problem, right? So it should be under the mission or so-called business sponsored visa, right? So that is the category we are talking about. So in this case, the difference is we are only going to tax the income which is attributable to the activity conducted in UAE. So that means only that 4 engineers, let's say example, came. So whatever income they earned in UAE is subject to tax, and you are required to register from a corporate tax perspective and pay. Now 6 months is critical because that creates a P. If they come for 1 week, 2 weeks, it's fine because they are coming, doing a process and going back. That's okay. But if it become an elongated period, that's where the permanent establishment triggers into. We're going to go and talk little bit detail in that in the further session. Now if you remember, we talked about this foreign entity also. Correct? This is also foreign entity registered in UAE because they have a control in UAE. This is also foreign entity. Correct? Both are foreign entity. But the difference is here I am going to tax the global income of the company in UAE. In the permanent establishment case, only the income which is earned in UAE is subjected to tax, not everything. There is one more section which says derived state source income. What is state source income? Very simple language. If I say any payment you make from UAE to outside, which is not classified in anything before, will be the state source income. Example, you purchase goods from a foreign country. What you are going to do? You are going to pay. Forex is going outside, right? We are talking only non-residents. So that means payment has to go outside the country. This becomes a derived state source income. Any services you have taken from a foreign entity, that means you are going to make the payment outside, also is a state source income. This is also taxed, but at the rate of withholding tax of 0%. So a lot of countries has a withholding tax. If you provide services, the payment goes out, they will deduct some tax and then send the money. Now what is the point of having 0% tax? Is there a point of having 0% tax? Yeah? Their own country they may be paying taxes, but why 0% UAE is brought up? Transparency, compliance. So right now FTA has not declared that we have to file a withholding tax return, but maybe we will get very soon where you have to file the withholding tax return. Now why this is important, again connect the dots of compliance. So this will tell us how much money we have remitted in the foreign country and whether in the foreign country they have accounted that as an income or not. So this will be a data share information which may be used at a later stage by tax authorities to make sure on the compliance angle. This has nothing to do with taxes, this has to do with compliance. Are you with me on the whole structure? So this is very important. So first 3 category are the resident people, second 2 category are non-resident people. Last, which is derived state source income, you are not required to register under the corporate tax. You are not required to register, only the withholding tax will apply. But in all other cases, you are required to register in UAE under the corporate tax framework and file your returns as is required. If you are registered in UAE, yes. If you are a foreign company controlled in UAE, yes. If you are a natural person more than 1 million, yes. If you have a permanent establishment, then also you need to require to register from a corporate tax perspective. Derived state source income does not require a corporate tax registration. But the person who is paying the money has to ensure he withheld 0% tax. That means your system should be capable to generate those reports as and when required. So any foreign payments you are making has to be accounted for, recorded. Sir, what should we do? The foreign party says, give me cash in UAE. Are you with me? I have purchased the goods, but the foreign party is saying, give me cash in UAE. Is it okay? Is it okay? He sent me an invoice from UK, but he said hand over cash to my partner in UAE. Is it okay? Yes? No? Third answer is also there, maybe. Right? So, very simple thing you tell me, if I am giving cash to him in UAE, does he have a P in UAE? Is there a collecting agent or a cash collecting agent sitting in UAE who is asking me to collect cash on his behalf? AML compliance comes and picks it up. No issues from a corporate tax straight away, but there is definitely AML compliance if you pay cash in the UAE for the supplies you receive from a foreign country. There is a circular from central bank which says that payment has to be made to an individual who has issued an invoice to you. How you are making sure that cash is being handed over to that company, not to someone else. So make documentation. Are you with me? Yeah. So that becomes an important part. It's not as simple as that. I am doing an export from UAE to a foreign country and cash is collected in UAE and I deposit it in the bank. Is it okay? I did an invoice for export of goods for 5 million dirham value of goods, and cash is handed over to me in the office. Is it okay? No. Reason, two reasons. Yeah. It should be transferred from the foreign entity, from the foreign country to UAE. But two reasons why it may not be okay. Because UAE has a condition that any cash cannot be imported in UAE for more than 60,000 by one person. If cash is not imported, if it is imported, then you will have a custom duty stamp saying that cash passed on. If you have that receipt that from a foreign country cash was imported and given to us, okay. If not, how it is generated in UAE? Who will answer later on to the compliance people that how cash is received in UAE? Why should we call it export if cash is received in UAE? All those questions has to be also looked into. So corporate tax compliance, when we talk about, has a lot of interlinkages which need to be evaluated when we look at those transactions. So are we clear with this? Perfect. So there are various category of things which are there. This is what the law is written, how the law is written. It says the first resident and non-resident person, what we saw in the diagram is what is written in the law. So if you want to read it, you can read it. We'll share the presentation to all the people who have registered with us. That this document will also come to you. So if you see, this is where it says the taxable income that is attributable to permanent establishment, state source income, and the last is nexus, is a word which is used in UAE. Now what is the meaning of nexus? UAE ministry has come up and say that anyone has a property in UAE will be defined as a nexus in UAE. Are you with me? So any foreign company having a property in UAE under their name will be defined as a nexus in UAE, and they are required to register from a corporate tax perspective and take care of compliance of that property. What if a foreign person has a property in his name? Is it okay? Or they are required to pay taxes? So I am a foreign person, individual, and I have a property which is earning a rental of 10 million dirhams a year. Do I require to register and pay corporate tax? Yes, no, both answers are there. Yes, wait for the answer, will come after few slides. But technically answer is no, with certain conditions. So nexus is what we talked about. This is what we referred. And this is where the state source income comes into play, just what we refer to any payment which is done to the foreign country. So income from sale of goods in the state, any foreign party has sold goods in the UAE, it is considered as a state source income. Anything which is services being received by the UAE party, that means we are paying money to the foreign entity, is also a state source income. So these are the pointers which comes into play. Withholding tax of 0% we referred to already. So this is just a law framework which I have explained you already. So just a quick catch up again. You have technically 5 source of income which are subject to tax in UAE. Now one pointer which I have already referred to, but still it's good to look at, any legal person, global income is taxable in UAE. Any natural person, only UAE income is taxable in UAE. That means income earned in UAE from or within the UAE itself, that is only taxable. Example, if I am a natural person and I am doing some business in my home country which has nothing to do with UAE, no control, no management from UAE, whenever required I travel and do my business in India, then that is not subject to tax in UAE. If I bring the control in UAE, then I have a problem. Otherwise, center point does not come into play. Any foreign company, by virtue of control also, if it becomes a taxable in UAE, again global income is taxable in UAE, not only UAE income. Are you with me? So legal person, global income, natural person, only UAE rated income is taxable. You may get a benefit of credit also. One differentiation which gets a lot of time discussed or debated is board of directors residing in UAE and taking decision will trigger what? If a board of director of a foreign company is residing in UAE and take decisions, what happens to this company? It becomes a resident company. If board of directors are sitting in UAE, but they don't take board decisions, but they do a typical activity decision, then what happens? P gets triggered, permanent establishment gets triggers. So there is a difference between control and activity. So example what we refer to, if your board decisions are done in UAE, then your global income become taxable, you become a resident. But the software example we talked about, 4 engineers came to UAE to work, only the income which is attributable to the engineer is getting taxable in UAE, not the global income. So that's a difference you need to identify, whether you are taking decision for company or decision for an activity of the company. If it's for activity of the company, only that activity gets taxed in UAE. Little difficult to identify, but you need to do it.
In the software case, the software
Software will be under the state source income.
No, like the software was produced outside.
Correct.
So we are getting taxed.
Not software, the people.
Only the people.
So let's differentiate both the things. Good question. I'll go back to, see this slide. My software will come under which category? This category. Software. I paid the foreign money for activity conducted in foreign country, right? State source income. But the 4 engineers will come under this category. Unless they are not distinguishingly identified. If you can't differentiate them, then everything becomes P. If you can differentiate them, then software is my state source and engineers is my P. That is the differentiation you need to look at. Are you with me? So only the engineer income is going to be taxed in permanent establishment, not the software in this case.
What amount is taxable, which is taxable? For example,
You need to register
only need to register.
first. Then you will have a threshold. Can you take a benefit of free zone? Under P? No. So that means you have a threshold of 375 and beyond. But registration becomes applicable. Withholding tax is only for state source income, software. Engineer, taxable. Registration is mandatory. And you will have a threshold of 375,000 for a 0% tax, that beyond that 9%. they cannot take a benefit of free zone. Aligned? Yes, as a foreign entity. Clear on that part? Perfect. There is a new enable which has come in which says transfer pricing. What is that? Related party, non-related party. Which are related party? Intercompany transactions, related party. What is other related party? Directors, shareholders, great-great-grandson, great-great-grandfather. All those are also coming up. But there is a simple concept which is used is arm's length principle. What is arm's length principle in general terminology? Yeah? Transfer price. What is? So when you meet a good friend, what do? You keep him under arm's length or you hug them? What do? Hug. So anyone whom you hug will be a problem in this case. So that is the word is used, arm's length. If I am keeping someone under arm's length, that means my relationship is not very good. I am making it a good, decent business relationship. It's a professional relationship. It's not a personal relationship. The moment personal relationship comes, my arm's length goes off. And the moment arm's length goes off, this section applies. Simple formula. Who are the arm's length? Don't tell me I stay away from my wife. But still she is still not under arm's length. Are you with me? Husband and wife keep fighting. So they say keep arm's length to me. But that does not come to this section. So anywhere where relationship can influence a business or a pricing decision comes under the transfer pricing category. And the decision, or you can say the section, is so wide to brought up into. I'm going to touch a couple of points, not everything, because this is itself is a full day session, but you will get a broad concepts. Got it? This is arm's length? No. That means all the transactions which are done between these two people has to be evaluated. Has to be evaluated. What it comes into? When we identify, how will you identify whether this is a related party transaction or not? Yeah? If I have a business with any company where more than 50% of the shareholding is with me, can I influence a decision or pricing with them? Yes. Or I have a more than 50% control with another company. Can I do that? Now this comes with alone or with my related parties. Example, I am a shareholder of a company 25% and my wife is also a shareholder of a company 25%, right? So are we holding 50% jointly with me and my related party? That comes into the transfer pricing mechanism. So it can be a decision making or a control or a shareholding. All these categories comes as part of it. The moment it comes, you need to identify which are related party transactions, and then you need to do an exercise to identify whether the value which is being charged is under the arm's length or not. Arm's length means if someone is already doing a selling to the third party and to related party, right? I am having a company, I supply to my related party companies also, and I supply the goods to third party also. Is the price comparable? If price is comparable, no problem. If price is not comparable, then I need to adjust to make sure that the price is as per the market standard. Are you with me? Simple we are talking about. If I am selling laptop from my company to my related party for 1,000 per laptop and to third party for 1,200 per laptop, is this okay? 1,000 versus 1,200, is it okay? Yes or no, both it can be. Now why I am saying yes and no? Assume in my company, do I have a credit risk? Do I have to be worried whether the payment will be received or not? No, because I know I will collect the money. But third party do have a risk? Yes, so there should be price difference for this part only. If that is managed, then we are doing a arm's length transaction. If not, then I need to do a price adjustment. That means I need to assume that related party transaction is also at 1200 and identify what is the profit which is coming up. This is where this section is becoming very important from a whole corporate tax perspective. In UAE, maximum entities have related party transactions. Either they are providing manpower or material or services. If you are doing that, you need to assess yourself from a transfer pricing perspective. Very typical example we have seen. I have 10 companies in the group. Accounts team is single. That means all the accounts team people are sitting in one company on one company's visa, but provide accounting services to all the companies. Possible? Why you are providing services at free of cost to other companies? It's a group company, so you are providing services to the group company, but sitting in one company. Will you do that for third party company also? If I come to you and say, do my accounts work free of cost, will you do? How much you will charge me?
Depends on the volume.
I gave you all the data. You said, let's say market rate is 5,000 dirhams per month, right? Should you not charge this money with your related party also? This is transfer pricing. Will you do any charity for anyone free of cost? No? Then why you are doing for a group company? They are saying, do work, but charge them. How will you charge them? There are various methods of doing a charge. FTA has come up very interestingly. They said if this is a non-core activity, just add 5% to the cost and recharge them. It's perfectly fine. You don't need to create so much of documentation. But it should be a non-core activity. Don't bring up a core activity. What is non-core activity? Support services. Accounting is a non-core activity. HR administration is a non-core activity. Support in marketing executions is a non-core activity. All those activities, if you recharge from a group perspective, it is perfectly fine. But add up cost plus 5%. How will you do that? I am working, again going to the same example. 10 companies, one accounts team. How will you distribute the cost to them for the accounts team? Salary, workstation cost, everything I will add up to the accounts team and say, okay, this is 1 million per year. Now how should I distribute? Based on? Revenue. May or may not be the right model, revenue. Why I will tell you? Because you may have, if as an accountant, I am raising an invoice of 1 million or 10,000. Does it make a time difference? As an accountant, if you pass a journal entry of 1 million versus 10,000, will it make too much difference? It will make little bit difference because you may say large value transaction will have a maker checker, small value will not have. But generally, what we recommend here is look at number of accounting entries as a gap and identify what is the ratio of accounting entries you do for 10 companies and a portion based on that. Simple. As an accountant, what is our role? So I'll give you a couple of metrics which you can use. For accounting work, normally we recommend use accounting entries. For HR services, we recommend use headcount. For IT software, we look at number of licenses per company.
Can I ask one? For example, the mother company decided we are not going to charge against the sister company for any service we are providing. For example, some companies, visa processing something will do some head office. So this one, if they decided like that, there are any problem in perspective of corporate tax?
Definitely. Now, the problem may have a different reasons. I'll come to that also. You are getting how you can segregate the cost. Accounting, how will you do? Based on accounting entries, HR, headcount. Looks logical or no? Software, let's say IT software, I may do based on licenses. Now his question is, our management said no, we are not going to recharge. Now I have a problem in understanding which entity is this. Example, if the head office is a free zone company, right? Or head office is a mainland company. Let's look at both examples. If head office is a free zone company and qualified for 0%, right? Will it make any difference whether I charge or not charge? And I come to the second question. If head office is a mainland company and subsidiary is a free zone company, head office is mainland company. If you put expenses, all expenses in mainland, right? Are you reducing your taxable profit? So there is a profit tax shifting happening? Problem. If both you say are mainland companies, we may have some reason to justify that. Because both are taxable. If you move one profit to another, what will happen? If this is not taxed, this entity will tax. It will be neutral tax. But if head office is a mainland company and subsidiary is a free zone company, you are technically booking all the expenses in a taxable entity and trying to take the undue advantage of taxes. So that is where it comes into. Second, you may have a loss-making company or a profit-making company. You are booking expenses in profit-making company and loss-making company, you say, why to put up anyway, it's a loss. So are these not tax non-compliance? So looking at all this stuff, it's always recommended to recharge respective expenses to respective head and use the broad transfer pricing mechanism. Are you with me? I'll come to that. So,
But why FTA did this? They lost 9% of that amount.
no, they've not lost.
No, like otherwise they would have got 9% for that.
For what?
This charge which we are putting for the sister company.
You will not make a difference. Let's assume, let's take two companies, both are mainland companies, right? Let's take an example, you will have a better perspective. Both are mainland companies, both are making 2 million profit. Correct? My common expenses is 1 million. Right? Had I not recharged it, which is half of million for both the companies, what is profit for one company? 2 million tax profit. Second company 1 million. Do I need to pay taxes in both companies? Yes. Now imagine I charge $500,000 on both, because that's where the transfer pricing comes into. What is the profit of this company now? 1.5 million. What is the profit of this company? 1.5 million. So there is no difference in this. But yes, the moment you have a free zone versus non-free zone, you are doing a tax issues. Because you may be booking more expenses in the company where you have taxes and more income in the company where you have zero tax. How will you manipulate the tax? If I have a taxable company, I would like to have more expenses in that. And zero tax company, I would like to have more income in that. Right? So this is where transfer pricing comes and tells you no, you cannot do that.
But both companies comes in one tax group.
In which tax group? Corporate tax or VAT? Corporate tax, then this is one entity only.
Consolidation.
There is one entity only. If two companies are part of corporate tax, it's a single entity from tax perspective. Recharge will not make a difference unless few cases are there where it will make a difference, where you come with the losses and go out and all that. So there are little complicated pointers comes into place. But generally it will not create a problem. Coming to VAT. If you are not part of a VAT tax group, any recharge is subject to tax from a VAT perspective. But if you issue the invoice, the same example we are taking, 1 million common expenses done, now you want to recharge to the other company. You will issue a tax invoice, correct? To recover that money. When you issue a tax invoice, it becomes an output tax for you and the other company can take an input tax, but you have to make a tax invoice. There is no exception for that if you are not part of a same VAT group. Are we aligned? Why TP is important, transfer pricing is important. I am a director of LLC company, 100% owned by me. I said, what's profit coming? 10 million profit is coming. Okay, put 9%, 9 million as my salary. Is it okay? Why it's not okay? I'm working for 9 million. What are you saying?
It's not I'm
It's not arm's length. So how will I get my arm's length? So then what you will do, you will identify a person like Rajiv with his qualification, with his experience. If we go to the market and hire a person, what is the salary we need to pay to that person? That becomes your arm's length price. Are you with me? So what we are trying to do, we are trying to just disassociate the related parties and treat them, if they are doing a transaction or that transaction is happening with a third party, how we are going to charge the prices to them. That is where it comes into. Aligned? So I cannot take 9 million. So that means I need to identify whether in my position, if someone comes from outside, how much salary I will pay them. If that is a value, then perfectly fine. Up to that is allowed. If I'm a sole establishment owner, right? And my arm's length price comes to 2 million of salary. Can I claim 2 million salary? Yes, no, maybe?
Yes.
No. For sole establishment, there is no difference between owner and company. In sole establishment, you are taxing whom? The company or individual? Individual. If you are taxing an individual, you cannot take any salary. For sole establishment, we have not picked up that point, but just to give a good perspective on that, sole establishments are taxed at an individual level. I am an owner of 5 grocery stores, 2 laundry shops, 3 restaurants and all that, but every company is a sole establishment owner. From a corporate tax perspective, you need to add up all and pay taxes. It's not each company. Add up all. So sole establishment does not have a legal presence. It takes the shape of a natural person, and since it's a licensed activity, it becomes business and hence it is taxable. Are you with me? So you cannot file 5 returns or 10 returns based on company. It's a single return and you need to consolidate all. On a top line, when I'm checking 1 million, because 1 million is not taxable, if your top line is less than 1 million, natural person is not required to register. So when you're checking top line revenue, you have to add up all the companies to check the top line. We have seen a lot of cases where sole establishment is run by respective managers of those entity. Example, one restaurant is managed by Mr. A. A laundry shop is managed by B. Their name are written the manager, but I am a sole establishment owner. Does it make a difference? No. Club up everything and then only you have to pay taxes. So salary to a sole establishment owner is not allowed. Even 1 dirham is not allowed as a deduction. For LLC, since limited liability company has a different structure, even 100% owner can take salary subject to arm's length principle and compliance to the regulation that he is working for the organization. I am owner of 5 LLC, right? I did my benchmark and I found a person with my capability can get 1 million salary a year. Are you with me? 5 organizations. Can I put 1 million in all 5 companies? My benchmark is there 1 million. Can I? Am I working for 8 into 5 hours? Am I working for 8 hours into 5 hours in a day? How much I am working? 8 to 12 hours maybe. If I am doing something extraordinary, I may be working for 15 hours. How can I get multiplied salary? So a lot of people are looking at a concept, okay, I did a benchmark and I am putting that salary in all the companies. No, you cannot. If you justify that I am working also in 5 companies, I need to justify how much time I am spending to each company, and equivalent amount can be apportioned. Maybe 1 million can go to 1.2 million because I am working in 5 organizations. I am spending more than 8 hours. I have some feathers in my arm, so I am doing some rocket science activity, but I cannot do beyond a certain percentage. Right? If market benchmark is 1 million, I can go up to 1.2 because you say that, okay, he is doing this, so hence we are justifying 1.2, but you cannot make it 5 million. So this is basic things which we are looking at right now on a discussion perspective. The moment owner sees the profit, they say, okay, put my salary, bring the taxes to 0 or near to 0. Definitely. That's what we said, benchmark. You need to identify what is my capability or my position capability to fetch a salary from outside.
In perspective of safety, recently the trend, people are focusing on that in order to shift to the profit, reduce the net profit. They are focusing with my salary as like this. Some LLC will have 2 partners or like that. So someone as marketing as, so I'm working for marketing.
Perfect. Make sure you have the documents also. So if you make a owner's spouse, I'm not using husband or wife, spouse who is non-active partner in the company and you're paying a salary to them, are you doing anything for the business? You need to prove tomorrow what the roles were they playing.
But normally the owners are not registered with MOHR right now.
They are in the general manager,
Managing the post of MOHR.
in the license, are they manager?
Director responsible.
Now, I'll give a good question he asked for. If the owner does not carry any Ministry of Labor document, neither they are in the manager in the license, can they withdraw salary? Ideally, no.
No, his service or his activities are directly related to part of the core business, then it can be.
Are they manager in the license? Are they? Then fine. In manager, if you see MOA, the duties of managers are written. Then that person is doing something. If not, then you have a problem. So look at those activities also what we are talking about. So look at the framework what we talked. Very simple. First, identification of related party. You need to identify. Second, you need to do functional analysis. Functional analysis is what this person or individual or the activity is doing. Example, in my previous example I said, if credit underwriting is done by one company, that's a functional. They are doing some additional thing. Can I do that benchmark difference? Yes, you can. Next comes, you look at economic analysis, how the transactions are differentiated between these 2 types. Then you look at benchmarking analysis. This is where you go to the database, search. Generally, if you have a transaction with the related party inside the company also and non-related party, do a comparison. That's the easiest way. If I'm selling goods to a related party, I'm selling goods to non-related party, I have already a comparison between that. Use that as a benchmark and then you do a transfer pricing analysis. Now, what are broadly considered from a RP perspective? First, 4th degree of kinship means my 4th degree relatives, me, my father, my grandfather, my great-grandfather, me, my son, grandson, great-grandson, and put a circle to that. All these are related parties. This is the structure which will come up. I am sitting here, self and spouse, and these all are related party. The challenge is even I don't know the names of these related parties. If I want to also, how will you identify that? Are you related parties anywhere in the room? You maybe if you start identifying it. Correct? So some village, some relation, some uncle, some aunt, somewhere. But that's very complicated. So sometimes we ask clients also, can you make sure that none of your suppliers and customers are in this category? Can you? In one organization, trust me, we found 30% of the staff is a related party. But they are hired in the normal terms. Why? Because from a respective state in a home country, they were hiring. And the hiring was from internal references and criteria. And 30% of the staff is related party under this category. Any issues? If I have 30% related party, no issues. So far I have followed the HR process. HR process means I have a very clear documentation of job profile. When I hired, I found 5 CVs. I looked at salary of 5 CVs, out of which I hired 1. That means I've already done a benchmarking exercise. Are you with me? No challenge on that. So this is where it comes into, and we need to look at from a transfer pricing perspective. Second, very rightly everyone said, any parent subsidiary branches, these are related parties. If you are selling and buying from them, it becomes a related party. Entities under common control, same POA holder, managing 5 companies, right? Same director, same manager, managing 5 companies. Although the owners are different, still control is managed by one person. That also becomes part of a control activity. Third, partners in unincorporated partnership. What is unincorporated partnership? Not registered. Example, any example of UAE unincorporated partnership? Very typical example. Yeah?
Silent working partners like that.
Silent working partner. No, it will be. Any example? How is this hotel property? How is this hotel? You liked it or no? Yes, no? Yes. Should we buy it? No? Me and Priyesh, we thought, let's buy this hotel. In the lunchtime, we'll go, we'll sign the property deal only, not the hotel, and we purchase the property in me and Priyesh's name. Are we partners? Are we partners?
Unless you are engaged with
We have already done a land department title deed where my name and Priyesh's name is coming and the property ownership is in our name. We have not done any company formation. Is it not a partnership first thing? Is it partnership? Yes, no. Yes, no. Is it partnership? Is it incorporated partnership? Then what it is? Unincorporated partnership. So this is one example which is very clear. Second, a lot of time we have joint ventures where 2 companies come together and bid for a contract. That is also unincorporated partnership between 2 registered companies. So this also becomes part of your transfer pricing framework. Last comes permanent establishment we talked about. So if you have a P in UAE and the foreign entity there, that also is a transfer pricing mechanism or story has to be looked into. And last, in some cases, you have exempt income and non-exempt income. Example, I'll tell you, government entities may have an exempt income and may have a taxable income. So within the company also, you may need to follow the transfer pricing. That is also an action plan which comes into play. So if one of my income is exempt income, one is taxable income, both has to be looked into a transfer pricing mechanism. That's also part of it. So these are all framework which comes from a TP perspective or transfer pricing perspective. This we looked at. 4th degree of kinship is the most complicated to adopt and look at how to follow it. Are you with me? Any questions on transfer pricing? I have not covered in detail. It's a vast topic, but I've given you a little flavor to start with. Any related party transaction has to be always looked into how we evaluate them. Next comes very interesting point which we covered a little bit on a natural person perspective. This is a law which comes and they talk about 3 income which are not taxable in hands of individual. Which are 3 income? First, the yellow highlighter points are important points for you to read through. That's why I've just gave it here. First is, for natural person, we cannot have different calendar years, different financial year. It has to be a January to December, full stop. So you cannot say, as an individual, I will calculate my income based on April to March or whatever. For natural person, it's only a Jan to December which is allowed, no other financial year period you can choose if you are a natural person. Second, there are 3 kind of income which are exempt, which does not count under the turnover. Turnover is, what is turnover meaning? Income, profit, sales. Sales. So top line, which we refer to, that has to be looked into. No gross up is required. You cannot do a sales minus purchase is my revenue. No, sales. Interest income, interest expenditure. Can I net off? No, for this calculation. It should be a gross. It's a gross. Word is gross amount of income. You cannot net off. A lot of time we have seen in the financials also, people say salary expenses less salary recharge from group. That's a net. You have to use the word gross in all the, from a corporate tax perspective, is very important. First is we are going to look at gross top line, and it has to be a calendar year, which is Jan to December, nothing else. Second, a wage is not taxable, irrespective of amount. 1 million, 10 million, 500 million, no matters. Should be under the transfer pricing. First thing is the wage that is given to an employee. To whom you give wage? To an employee. In consideration of the services under the employment contract. Whether in cash or in kind, both are fine. Payable annually, monthly, weekly, daily, hourly, whatever way you want to give, no problem. Or by piecemeal and include all allowances and bonus in addition to any other benefits provided for in the employment contract or in accordance with applicable legislation in the state. So that means the salary paid should be only to registered employees. You cannot make a consultant saying that I am paying salary. That doesn't make sense anywhere. Only a salary contract is applicable. Then comes the personal investment. We talked about any personal investment is also out of the discussion or out of the preview from a corporate tax perspective for individual, no one else. Third,
In the salary, getting addition to salary, commission is allowed. It is getting
is a owner or non-owner?
employee.
Employee, no problem.
But in contract not mentioned.
No problem.
Unlimited.
As per the terms of the agreement. See, if contract is not there, you have a terms of agreement, right? Correct. You are paying through WPS system or whatever protection system is there for the for the authority, no problem. End of year bonuses are also allowed. We are not talking owners right now. Owners are very different discussion. Here, pure employee, pure when I say, no related party, and you are paying a salary, you are paying annual bonus, you are paying incentive, everything is allowed as a deductible expenditure for the purpose of business. Not since he helped you for home, you are paying bonus, it's a different story, right? So anything to do with business, everything is allowed. Lot of real estate broking firms, they have employees where salaries are very limited, but the bonuses are huge, right? Based on the sales, what they do. So which is perfectly allowed, no issues. Only in case where you are paying a salary to a manager who is a owner also, you are not allowed to pay any incentive or anything which is linked to salary, linked to profit, sales or anything. You cannot pay anything. Owners are different or which are related party. Normal employee without having any relationship, anything which is paid as incentive, bonus, direct, indirect, everything is allowed. Coming to real estate investment. Here, you remember we asked a question before. A foreign entity having 10 million as a rental income. Anything or any property which does not require a license to operate is exempt from a corporate tax perspective for all individuals. Let me use a very simple thing. Wherever you do a ijari based activity, I have a property which can be a commercial, which can be residential, which is in my name, and I did a ijari to rent that property. Everything in that category is not taxable for natural person. A lot of people get little confused. Corporate tax is not taxing, but VAT, there is a tax on commercial property. Both are different subjects. You may be doing a value-added tax on commercial property, but from corporate tax perspective, commercial, residential, both are not taxed, subject to they are not under the licensing requirement. Now what is licensing requirement? If you are having a business center, right? If you are having a business center, that means commercial property, but you are giving as a business center. For running that, you need a license. It is a business income. Short-term rentals, For property, you are using a short-term rentals, Airbnb equivalents or something like that. That is also a business. In both categories, it is taxable. Otherwise, real estate, 1 million, 1 billion, 1 trillion does not make any difference. So if a non-resident person earning a rental income of 10 million, it is not taxable. So far, it is Ijari based rental, not the square feet based rental or broken or business license is required. Perfectly fine, no issues. I'll split that situation into a simple thing. You remember me and Pritesh had taken this property? Remember? Okay. Now what we did, this whole property we gave on rent to Millennium Hotel to run. Are you with me? So we have one Ijari which is made between me and Pritesh as one partner and the hotel as second partner for taking the property on lease. We are getting 10 million as a rental income. Is it taxable in hand of me and Pritesh? No. But from a hotel perspective, they are running a business. This rent what they paid is a deductible item in the hotel. Perfectly fine. Are you with me? So far. Now, me and Pritesh both are joint partners, right? So how should we break that income? How will we split that income? We got 10 million. I said 3 incomes are not going to be counted as a turnover for a natural person. What are those incomes? Salary, wages. Second, investment income, which includes dividend, capital gain, everything. Third, real estate, which is not licensed, right? All these 3 incomes, turnover is not going to be calculated for 1 million calculation. Example, if you have someone who is running a sole establishment and is having a real estate also, right? From a real estate, the rental income is coming for a year, 2 million dirham. But on a business, he is making only 300,000 or 400,000 as a top line, right? Do he require to register for VAT, for corporate tax? Answer is no, because on a turnover basis, I am not going to count real estate. I am only going to count business top line, which is revenue, which is less than 1 million. So he is not required to register. Are you with me? So the 3 things are not going to be counted from a corporate tax perspective for individual, which is natural person, which can be a sole establishment also. So all those things has to be looked into when you are assessing for an individual. What if I am having a large warehouse, right? And someone came to me and said, Rajiv, why don't you give 1,000 square feet to me for keeping my goods? I have a warehouse which is 20,000 square feet and I'm not giving it to anyone. I'm using it for my business or third party or keeping the goods or whatever. So the individual came to me, he said, why don't you keep it? Give me 1,000 square feet, I'll keep my stock. Whenever I want, I will take it. Whenever I want, I will leave it. Is it a real estate income? First question. Is it a real estate income? Technically rental only for the area, but it is not. This is the category which is called right to use selling. You are selling right to use. There is no ijari in this. Hence, it is not a real estate income. So be careful when you assess something as a real estate or a non-real estate. We need to be very clear in that articulation. Are we aligned? Perfect. Let's look at further. There are various types of persons which are being defined. Just maybe a catch to everyone. Towards the end of the session, there is a small poll which we are going to take. Please make sure your name and email ID is properly written, because that's where you get the certificate and the presentation also. Are we clear? So make sure your email ID is correct, because if that is not correct, you may not get the certificate and the presentation. Both will come in one go to your ID. So there are various legal persons being defined in the FTA portal itself. This is completely a copy of FTA portal. We have not done anything straight away from the FTA portal perspective. You can see there is a natural person, there is a legal person, incorporated, foreign entity, club, charity, federal government, Emirates government, others, partnership. All these are important to be categorized in the right way. If you categorize a sole establishment as legal person incorporated, in case FTA is generally rejecting those cases, in case it gets approved also, you will have a problem in reassessing your corporate tax return at a later stage. So this is the most important thing to look at, which category your organization, your company is to be registered. Very big difference between legal and natural person, because the tax structures are very different in both cases. Are we clear? So just a quick grab, natural person are individual and other natural person. What can be other natural person? I gave an example, you remember? Me and Pritesh has taken this property. No one said congratulations. We did such a big deal, right? So the income which is coming to us is whose income? My income, Pritesh income, or a company's income? My income, company income, or Pritesh? Me and Pritesh together. How you define that? Unincorporated partnership. So I am leaving this structures and all, which we'll look at. So you perfectly rightly picked it up. Unincorporated partnership. Something called transparent structure. What is meaning of transparent? See-through, right? So this partnership is treated as pass-through structure. That means transparent structure. I will see through who are receiving the income. Example, in this case, unincorporated partnership, me and Pritesh has earned rental, right? It will go through and distribute the income and expenditure in my and Pritesh ratio. Assume I am 60% owner, he has left, so I am making myself 60% owner, and he is 40% owner. So what will happen? Our income will be distributed in 60-40, and expenses also will distribute in 60-40. So all the income which has come to my angle, now who am I? Individual or company? Individual. Real estate is taxable in the hand of individual or taxable or exempt? For individual. Real estate, no license, so it is exempt. So the income which I earned from here is not going to be taxed the moment you put a transparent structure. You have a choice to make unincorporated partnership as a legal entity, but for that you need to go and take approval. In FTA, if I want to treat partnership as a transparent structure, no need for approval. But if I want to treat it as a legal corporate, I need to take an approval. So you can register with FTA, unincorporated partnership, and file the return under unincorporated partnership also. But this is a very interesting tool which a lot of organizations and a lot of large corporates are using to on the advantage from a tax perspective. Not only tax advantage, but other things are also part of it. I'll just go through that. So you looked at various conditions are there which has to be applied. In this case, clause 2 is the important condition which has to be applied. One, you should be conducting a business as an unincorporated partnership. That means it should not be registered. So for having a joint property, do I need to register somewhere? Is it mandatory? No. So both individuals can join hands and create an unincorporated partnership. There is no question asked. Having the status, intention and purpose of unincorporated partnership. So I want to carry the same thing. I don't want to make it incorporated at a later stage also. Holding assets that unincorporated partnership holds. In this case, what is asset? The building is asset which we are holding. Being party to any arrangement to which unincorporated partnership is a party. So all these conditions, if they are met, this is treated as transparent structure, and that is where the benefit of transparency comes into play. But what is the main advantage which comes when we use this transparent structure? I'm going to talk very short period on that part. We have looked at all these points I've already given. Is when we incorporate something called foundation. How many of you know foundation, trust kind of structures? It can be for charity purpose also. But why we create foundation or a trust? What is the meaning of that? What is the benefit of that? We'll come to tax later on. But what is the objective of creating a foundation? For For asset? Saving. Social service? Lot of time we created for non-social service also. Proper channel. Okay, I'll give some examples. Right now, the next generation which is coming, we don't know how they are going to utilize the money which the father or the mother or the parents have generated. I want to give wealth to my family members, but I don't want them to have a control on the wealth. Right? What if I have assets of 100 million? Let's take a big number, right? If I have assets of 100 million and I give those assets to my family member, tomorrow what will happen to me? Am I right? So what I want to do, I want to make sure they get benefit, they enjoy it, but they don't have some of the rights which I want to control myself. So I created a foundation. In the foundation, me and my wife, we both become, I'm using some technical words, please understand that this is more important than corporate tax also. Me and my wife, we both become settler in that foundation. Settler means who settles their wealth into the foundation or a trust. In UAE, we'll use the word foundation again and again, right? So we brought 100 million into the foundation and we created a foundation. Now this foundation has beneficial owners. Who are beneficial owners? My family members, whom I want them to take the benefit. Remember the word we talked about beneficial ownership before also? The person who enjoys, who are the beneficial owners, but they are not the owners. I have various methods of creating a foundation. One foundation I am creating is, they have a right to enjoy the income, but they don't have a right to dispose the assets. 100 million value of assets may include investment in companies, may include investment in properties. Whatever income come, every year we'll distribute to them. But no one has a right to touch the asset till the time certain conditions are met. Are you with me? So in this case, there are two characters we talked about. One, settler, which is me and my wife. Beneficiaries, my family member. But I need someone to manage that. Correct? Like in company you have directors. In this case you have council members or guardians. So those council members or guardians are the directors of this foundation equivalent. Like in company you have directors, you have council member or guardians which are part of it. If you have this structure, then you can apply to FTA to treat this foundation as unincorporated partnership. You need to apply. By default, it is considered as a company only, and it will be taxed as a company. But you have a choice to apply to FTA and say that we want to take a benefit of unincorporated partnership. Now, what is the benefit of unincorporated partnership? As I said, I created foundation for what purpose? Two purposes. To hold the companies where I have invested and to hold the assets, buildings, property, real estate where I have invested. Both income in the individual's hand are exempt. You remember we talked about that. So if I create a transparent structure, what will happen? Let's say I earned as a foundation 10 million as a profit. Let's assume profit expenses are equal for the benefit of all. 6 million I received as a dividend from the company we have invested. Are you with me? Yes. And 4 million I received a rental on the properties which are held under the foundation. If I treat this as a transparent structure, the beneficial owners will receive the income. Correct? If beneficial owners are receiving the income and it is treated an unincorporated partnership, is investment income taxable in hands of individual? We discussed, right? 3 incomes are not taxable in hands of individual. So investment is not taxable. It will be out of the discussion and not treated as a turnover also. And second, rental income, will it be taxable? In individual hand again, rental income is not taxable. So both income become out of context. So when you treat it as a transparent structure, nothing is getting taxable in this category, in this example. But certain conditions to be fulfilled. You cannot do business in foundation. It has to be a passive investment company. What is passive investment and what is active investment? When you sleep and money earns, is passive. What are those passive income? Dividend income, passive. Rental income, passive. When you have to actually work, that is active income. Consulting, manufacturing, these are all active income. So this foundation cannot have any active business. It should be only a passive investment. That means they can invest in the other companies. All those things can be done. So you look at the conditions which are required. First, family foundation is established for identified natural person or identifiable natural person. What is the meaning of identifiable? What is the meaning of identifiable? I have only kids, but I want to make my grandkids also as recipient or beneficiaries. I can write there my kids and future generation. That is identifiable at a later stage. They may not be there right now, but under the foundation you can put up those conditions. And for the benefit of public benefited entity, not for the corporate. No company can become a beneficiary. That is the first condition. Second condition, the principal activity is to only receive, hold, invest, disburse or otherwise manage assets. And it should be only from a passive investment company. And you are not creating the foundation for the purpose of tax avoidance. You are creating the foundation for inheritance planning, other things, but not for only tax purposes. So if all these conditions are there, this tool is very amazing tool to get a benefit of no taxes. That means it is treated as an unincorporated partnership, get a transparent structure and everything becomes tax free. So this is where the foundation structure comes into play. Now a couple of questions which people have asked me during the break and other places also. Non-deductible expenditure. What are the non-deductible expenditures? As I said, anything which is not legally paid may constitute a non-deductible expenditure. One example we talked about in the morning itself. You paid commission referral to someone who does not have a right to do business in UAE. Can it be deductible expenditure? Bribe kickback, is it deductible expenditure? Non-deductible, right? So one simple question came to me. Our office people go to the labor market, pick up labor from there, get them work in the construction sites, and evening they pay cash to them. Correct? Will you be able to get deduction of this if they have work permit? Under what? Under your, no, they are not in your company work permit. If they are, then you will not go to the labor market to pick it up. Morning you go to the labor market, get the labor, get the work done, evening cash paid, finished. Second, you get a transport guy come to you, he will do work for you during the day. In the evening on the parcha, he will write 500 dirhams, you pay him 500 dirhams, he went off. Can you get a deduction? Do you have an invoice? First question. He may not be under the preview of a VAT, fine, no problem. VAT is not mandatory, but at least trade license is mandatory. At least the activity is mandatory. If not, how will you get a deduction? You tell me. How will you prove that you have not pocketed this cash in your pocket and paid to someone? First question. How will you prove that? Payment voucher? Who has signed that payment voucher? Who has signed that receipt? Where is the company name? Where is the trade license? Under what condition you made a payment? I am asking simple question. You tell me. No, we'll go to deductible, non-deductible later on. But first question first. Had you given this money to someone? You prove me first thing. Difficult to prove? I'm saying simple thing. See, normally you get a parchi or something which you get in the stationery shop as invoice and you write a name which is also not readable and write 500 paid. How will you prove that you have paid this money? Some CDD has to be there. Customer due diligence with whom you are doing business. UAE is a very different market. Please take it in that way. We are not allowed to have people do business without an adequate license. Adequate license includes a freelance visa also. That is also adequate license. But has to be documented something that they have an establishment, they have a visa, they have some activity to perform into. Otherwise, how will you prove it? Forget FTA, what they ask is different. As an accountant, will you be convinced that he has paid the money? Or that employee himself has made a voucher? I don't know. I'm not trying to say distrust them, but I'm trying to say how will you convince yourself and then the tax authorities? It's not? Multiple things. So answer is lying with us only. If these are the invoices, are we able to prove it? If not, please stop there and then itself. Since you are paying whatever you are paying, add 9% to the payment of that also. So this will become a non-deductible. So anything which is not related to business, which does not have a right supporting document, does not qualify for these expenses. A lot of time we get invoices from the owners saying that book kept in the company. All the expenses done on a kitty party of spouse, correct? So how will you claim that? Business expense? Business meeting? So that question has to be looked into. Various non-deductible expenditures. First, donation, grant, gift made to an entity that is not a qualifying public benefited entity. So there is a list of public benefited entities. If you give donation to them, then only it is allowed. Otherwise, since you are giving anyway donation, add 9% also. That means this is non-deductible. So if you are giving 100 donation, consider you are paying 109 and treat it that way. Become a non-deductible unless it is a entity which is registered under public benefited entity. Fines, penalties, non-deductible. Any fine penalties you pay is non-deductible. Bribes or other illicit payment. So this is what the example, if you remember in the morning, doctor, illicit payment. Not allowed as per law. Bribe. Sir, we have to get a contract, so we paid something to someone. It's a bribe, kickback. Okay. Invoice is issued to the spouse of the person who is working in X organization. Comes under the category of kickbacks, bribes, not deductible expenditure. Dividend, profit distribution or benefit of similar nature paid to owner of a taxable person. When you pay dividend, post-tax, correct? Profit, tax, whatever is left is the dividend income. That is anyway coming after tax only. So don't take it before tax. That is where it comes into. Amount withdrawn from the business by natural person who is a taxable under paragraph C of clause 3, 11 of decree law or a partner in an unincorporated partnership. So we discussed in the morning also, sole establishment owner cannot withdraw any money as a salary because there is no differentiation. It comes as part of non-deductible expenditure. Any corporate tax you pay, by default, corporate tax is after the P&L line item. Input tax, which is recoverable. Small input tax, sir, we don't claim. Okay, don't claim. In the corporate tax also. Small input tax you receive. So in generally what we do, we take all the value into the P&L. We hit directly to P&L. Let's say example, your boss came, he has a coffee with somewhere else for 100 dirhams. So 105 was the invoice. So what you do? 105 goes to P&L? No, you cannot do that. 100 will go to P&L, 5 in different head, input tax not claimed, and this is not deductible under the corporate tax. Unless it does not have a provision to allow you to claim the input tax, is fine. But wherever you can, you should, and if you are not, don't claim the benefit under corporate tax also. So one general ledger you have to create, input tax eligible, not claimed. It has to be added back.
So twice we lose.
Yes.
The input work also lose,
Yes.
also corporate tax. So
Yes.
like twice.
Yes. Either you take the benefit.
If it is charging, at least we will get back.
Correct. So you cannot take a choice of not claiming input tax. If you are taking a choice, then take a choice of corporate tax also. But the important part is how will you get that number? No one has generally those ledgers. Input tax not claimed. Everything goes to P&L. So that differentiation is a most important thing. We found it difficult with the clients to identify this value. Right? Otherwise, we have to pick up all small invoices which we said we are not going to claim and identify that value. So it's a difficult thing to do. Tax on income imposed on the taxable person outside the state, anything which is paid outside the state, you cannot take a deduction. And such other expenditures specified in the cabinet decision, there are various decisions has been come up, and we are going to talk about that. So let's come to free zone. Just a broad perspective. Unless we don't get the point of custom suspension, duty paid, we are not understanding the free zone in a right way. How many types of free zone are there broadly? How many types of free zone are there? Perfect. Broadly we can say designated free zone and non-designated free zone. Designated, which are approved by FTA under VAT framework, saying that these are designated free zone. Why those are designated free zones? Why those are designated free zone? No, which is fine. Business boost and all we discussed in the first session, because they are in the custom boundary. Any designated free zone, you will see there will be a border. You cannot go inside easily, you cannot come outside easily, right? Why they put up borders? So that goods which are moving are tracked for custom payment. I'll give one simple story to you. One day, a gentleman came in a bicycle and having a bag of sand at the back of the bicycle, and he was taking out the bicycle. The custom guy stopped him. He said, "Where are you going?" He said, "Sir, just a sack of sand I'm taking out." He looked at it, put his hand also to identify there is nothing. He is hiding in the sand and taking out. And he found nothing. He said, "Okay, go." Next day again same thing happened. He came with the sand box. He said, "What is this?" Second day, third day, fourth day, fifth day, 10th day. He got worried. He said, "What's happening? Every day he's coming with sand. What he's exporting? Sand is not something to be exported, right? We have everything in the city also." You know what they identified? He was taking the cycle out every day and people were focusing on sand. So that is where we need to look at how the transaction is manipulated in a lot of cases. So this is the whole story, and there are various definitions which are there in the free zone activity. One is qualifying income, free zone person, qualifying free zone person. So these are the definitions which they have provided, and the first definition says a designated and defined geographical area which is approved by the ministers is defined as a free zone. Anyone who is operating in that designated area is called free zone person. And any free zone person who is doing the activity which make them get 0% benefit are considered as a qualifying free zone person. There are conditions which are there to be Article 18, which has to be met. Now there are broad conditions which has to be looked into when we call someone a qualifying free zone person. That means they are doing the activity in a right way. So any free zone person will not get a benefit of 0%. They need to comply to these conditions minimum. And these conditions are not or, they are and. That means all the conditions has to be met. Are you with me? First condition, maintain adequate substance in the state. So remember we talked about substance in the morning? Economic substance. That means you need to have an office. You need to have people. You need to have assets, minimum, to run this kind of a company. Sir, I have a free zone company license. Okay, who sits there? No, it's a flexi desk. Who sits there? I have not seen the office also. Do you have any visa? Yes, 2 people have visa. They are sitting in my mainland office. Is substance met? Substance met? Visa is there, but do they have office? Flexi desk is there. Are they operating inside the free zone? How will FTA know they are operating inside or outside? That's a question which a lot of people ask, right? How will they know? They know everything. First answer. If they want to know you are sitting in this room, will they know or not? If they want to know you are sitting in this room, the government, authorities, do they know or not? How you came? Either with your car, and car is tagged to your Emirates ID, and Emirates ID is tagged to you. Correct? Or you came in your, whatever method you used, If authorities want to know, they know where you are. So one question which I keep asking people is, okay, you have a free zone in other Emirates, let's assume ABC Emirates, not Dubai, and people have vehicle sitting in UAE, people are based in Dubai. How will you make sure you were visiting in that office to operate it? Multiple questions. Don't get into how will they know, they will know. That's our first point to start with. So you are not maintaining a substance if you are not operating from that office in the free zone. You have to operate from that office. You cannot make people sit in the mainland, and I'll tell you why I'm saying that also in a short span. Second, derives qualifying income. We'll look at that very shortly. There is one more condition. As I said in the previous session, in a free zone person, if you are having a qualifying income and non-qualifying income, there is no threshold of 375,000. But if you believe, I cannot get into this compliance, I just want to ensure that I pay taxes and I get a benefit of 375,000, then under Article 19, you can go and say, I am going to pay tax as per normal company, not as a free zone company. Then you get a benefit of 375,000. Let's say my income itself is 300,000. Why I get into a free zone and story and all that stuff? My top line is less than 3 million. Why I am getting into this? I'll get a benefit of small business relief for a couple of years. Why I am getting into this? So I straight away go and say that I am not taking a benefit of free zone, but I will pay taxes under the normal condition. The moment you say that, you have to keep saying that for next 4 years also. Are you with me? The moment I come out of the benefit of 0%, not that year, 4+ years, that means total 5 years, I will not be able to take the benefit of free zone company. That means I will keep paying the taxes based on the normal regime, whatever income and expenses comes. From the 6th year, I can reassess myself, but not for 5 years. This year plus 4 more years. Next comes, complies to Article 3455. That means arm's length principle, transfer pricing has to be applied. Why? Because you're sitting in a free zone. If you don't apply, you have a tendency of showing more profit where? In the 0% company, which is free zone, and more expenses where? In the mainland. So to make sure that we don't manipulate the stuff, this is important. And further, 2 conditions which are prescribed by ministers, which is 1, audit is mandatory. If you want to take a benefit of free zone, audit is mandatory. Second, you need to comply with the de minimis condition. Now, de minimis is also very interesting, where a lot of people are losing the benefit. There is a condition of qualifying and non-qualifying, right? We discussed. Except for few activities, if non-qualifying income becomes more than 5% of the top line, non-qualifying income becomes more than 5% of the top line, revenue I'm talking about, now I'm not talking profit, then you lose the benefit of full structure from a free zone perspective. Example, my top line is 1 million, right? And non-qualifying is 200,000. 200,000 is what percentage of 1 million? 20%? I lose the benefit of full income. It's no more the ratio of qualifying versus non-qualifying. So if you turn around and check your non-qualifying income is more than 5%, you lose the benefit of full free zone and you will not be able to enjoy any of the benefits. Are you with me? So this is the condition which comes into one more condition which is in red, very interesting condition. Remember we talked about any foreign entity, if it is controlled from UAE, become a resident of UAE. A foreign entity, if it is controlled from UAE, become a resident of UAE, right? What if my subsidiary is in the free zone and I'm controlling that foreign entity from the free zone? Can I take the benefit of free zone? Foreign entity is controlled by a subsidiary of that foreign entity and that subsidiary is in the free zone. Can I take a benefit of a free zone for the foreign entity? Answer is no. If any foreign entity by virtue of control brought up into the UAE as a resident person, it by default becomes a taxable and under the category of a technically a mainland company. They will not get the benefit of any free zone. There's a lot of drawback which is there on this, and we'll talk on that as we move along. So conditions, there are multiple conditions. I will get into very specific activity. How many of you are expert on VAT? Experts on VAT? Okay. No VAT. Little bit, only 1%. We need to have a VAT class also then. See, from a VAT perspective, morning I think a lot of people have told us, if you are doing a free zone to free zone transaction, there is no VAT being applied. Are you with me? Correct? So let's say if I transfer goods, okay, let's forget it. Let's start with a story. Story is better. All of you travel outside UAE? Yes? Next time when you travel, go and check how the people are invoicing in the airport. When you buy a computer or a laptop or any electronic item, do they charge VAT to you when you are exiting the country? Do they charge VAT? No. Anything beyond the custom control is what I am talking about. After custom control, if you see electronics activities or electronic items which are sold, they are generally not with VAT, but if you take a burger or a food item, VAT is charged. What is the reason? Consumption versus non-consumption. When you are taking electronic goods, can you consume it there? Technically, it is considered as an export of goods. Hence, taxes are not charged. But when you take food, generally you are going to consume it there. Sometime I take my home also. But generally you are supposed to consume there. That is where VAT is a consumption-based tax. VAT is a consumption-based tax. So where you consume, you pay the taxes there. That is why on export, the taxes are 0%, not charged as 5%. So because there is no consumption happening in UAE. Similarly, what I did, I imported coffee beans from Africa continent to UAE. Are you with me? Coffee beans imported into UAE in my Javza warehouse. Do I need to pay any VAT on this? Okay, let me ask first question. Do I need to pay any custom duty on this? No. Why? Because goods are in the custom bonded area, Javza. Javza is a custom bonded area. So I am suspending the custom to be paid. Are you with me? So far no custom duty, hence no VAT will be charged. I use those coffee beans to toast it, roast it and grind it and make it a coffee powder. Correct? Do I need to pay any custom duty now? I am not selling right now. I just grind it, toasted in my own warehouse. Everything is done. So not sold, no custom duty because I am not taking goods outside. I made sachets of 100 grams. Out of these 100 gram sachets, I am exporting some sachets to Sharjah Airport Free Zone Authority company, which is also a designated zone. So company is selling goods from one designated zone to another designated zone. Do we need to pay custom duty? No, subject to condition. Goods should move under the custom suspension from one location to another, should not open the package in between. Anything transferred between Javza to Davza should be under the seal condition. All those conditions are there, no custom duty is applicable, no VAT will be applied. Correct? I sold a couple of coffee beans to a Javza entity, which is another Javza entity in the Javza itself. Do I need to pay any custom duty? Again, no, but I need to make sure goods move from my custom suspension to the buyer's custom suspension records. Aligned? Now, a twist. I have a coffee shop in Javza itself under the food court where we sell coffee to people, coffee cups to people for drinking, right? When I transfer this coffees from my warehouse or my production to my shop, which is selling coffees, do I need to pay custom duty and VAT? Yes. Possible, right? But who will pay the custom duty? The manufacturing company or the coffee shop? Depends. Who is importer on record? The word which is used is who is importer on record. Who will give their import code to the custom authority? The moment you give an import code to the custom authority, that becomes an importer on record. And the moment you import the goods in UAE and pay the custom duty, by default, VAT will get triggered in your FTA portal under box number 6. If you know the boxes, box number 6 is import of goods. That is where goods are imported and will be reflected. So this is where things are very important to understand. So far, your goods are transacted outside the scope of VAT. It is generally outside the scope of corporate tax also. The moment you pay custom duty and you are selling taxable goods from the free zone also, it by default becomes a taxable for corporate tax also. So there is a very connecting linkage between customs. The moment custom is paid, VAT will stand. The moment VAT is paid, corporate tax also may stand. Some conditions are there which need to be looked into. Are we aligned? So this is where a lot of conditions are there which is considered as consumption. In free zone, if you are consuming the goods, you end up paying taxes. As I said, coffee is consumed inside the free zone, but still I am paying taxes. Correct? But if I am using parts and consuming it to make a car, am I really consuming the goods? No, I am using those goods to manufacture something which is sold under the tax regime. That's perfectly fine. There is no VAT also charged in this, and corporate tax also may not be getting charged in these conditions. There are very interesting aspects. We talked about these scenarios. This is a recap of the coffee. All examples and framework is given, which is what I just told a story to you in 5 minutes. What is the difference between zero and out of scope? First, let's understand. Zero input tax is taken care of. Under out of scope, you cannot. You can. Exempt, you cannot. So let me difference now into zero, out of scope and exempt. There are 3 things. Right? What is exempt income under VAT? What? Export of goods? No, it is not exempt. Rental income from residential building which is not the first sale. Yes, it is exempt. Any interest income or margin based product is exempt. Land, bare land is exempt. So these are exempt income. Government project, no. So under exempt income, you cannot take a benefit of input tax and you are not required to register also. Aligned? Aligned? You are not required to register also. There is no threshold check, 375,000 for exempt income. Zero rated is when we do a transaction which is defined under the law as zero rated. Law, how they have defined under VAT, they have defined these are zero rated activity, these are exempt. Correct? And they have provided a condition of place of supply. If all those conditions are checked, anything other than that becomes an out of scope transaction. Out of scope transaction, let me define first zero rated. Zero means I have purchased goods by paying taxes in UAE and I export them. What is this? Since I purchase the goods with 5% VAT, I need to take input tax. When I export, it is considered as zero rated. Are you with me? School. Zero rated, exempt. Primary education, zero exempt. Zero exempt. Zero, because I am taking a benefit of input tax. Primary health care, zero exempt. Zero rated, because hospitals are taking benefit of input tax. These are zero rated. Now coming to out of scope. I purchased the goods from China and sold to Africa. China to Africa, third port shipment. Do I need to, is there any input tax? Is there any output tax? This is an out of scope transaction. This is an out of scope transaction. But in out of scope transaction, if you are having expenses which are done to do that out of scope transaction, you can claim input tax on that. Subject to, you are registered for VAT. So I'll give an example. I do third port shipment primarily, but I have a couple of transactions which are 0 or 5% amounting to 500,000, which is beyond 375,000. That means I am required to register for VAT. My office rent itself is 5 million. My office rent is 5 million. From there I am managing out of scope transaction, third port shipment and everything. Can I claim benefit of input tax on 5 million rent? I can. Because the law says you can claim an input tax on out of scope supplies had those transactions, if being conducted from UAE, is subjected to tax. If I don't do a third port shipment and I bring the goods from China to UAE inside and I export it, what will happen? How the transaction will be taken? When I import, what I need to do? RCM. When I export, it will be zero rated. If I do transaction in this way, will you give benefit to me on input tax? Will you give? So law is saying don't bring the shipments only for taking input tax. Will give you the benefit of input tax. That is where the framework comes into play. Clear? We'll look at more examples also. Now, from a law reading perspective, law has to be read in 4 angles. How you are going to read the law? First, what you read? Law, ministerial decision, cabinet decision, or FTA decision. First, what you read? Law. First, you will read the law. Next comes the cabinet. Below that comes the ministerial decision, and below that comes the FTA decision. That's a sequence of reading. So that is where it comes into. And from free zone perspective, there is one cabinet decision and there is a ministerial decision. Both have to be looked into for benefit of arriving at what need to be looked in. These are very specific decisions which we have brought up for your angle and to review it out. Now, these are a couple of examples. So I was talking about, example you said, if someone has a visa but operating from mainland, what will happen, right? Correct? I have a free zone company, but we are taking all the decisions from mainland. All the team on the free zone visa are sitting in the mainland. It will trigger a domestic permanent establishment. That means that individual who are sitting in the mainland, all the income related to that will be subject to 9% tax straight away. So if you create a substance also by showing whatever you are showing, still all the income become taxable by the virtue of permanent establishment. So these are little enhanced version of how the free zone is getting operated. You cannot work in the mainland by any employees of the free zone, not even from your house also. If you are operating from your home also, that is also considered as a permanent establishment because you are taking constantly decisions in that location, which is not a free zone. Any work you do outside the free zone is subjected to tax. Only inside the free zone is where you can get a benefit of. Here there are a lot of definitions are given, and there is one definition which is important to pick it up and understand, which is a commercial property. Commercial property has various definitions under VAT and very different definition under corporate tax. Corporate tax says one immovable property or part thereof used exclusively for business or business activities, only commercial property. Not used as a place of residence or accommodation, which includes hotels, motels, bread and breakfast. Hotels is what's considered in the VAT side, commercial or residential? Hotels are considered commercial or non-commercial? Commercial in VAT. In corporate tax, they are not considered commercial. So that means a hotel in a free zone will not get any benefit of qualifying income. They are treated as par to any hotel which is outside. So any labor camp, any bread and breakfast, any hotel, anything to do with activity is not considered as a commercial property. So hence the definition in respective law has to be read to understand the law perspective. Designated zone, they are using the same definition what is there in the VAT law from a corporate tax perspective in the free zone. Next comes, now there are various, broadly two kind of income which are there. One, where I am selling to a free zone. or I am providing services to free zone to free zone transaction, we need to look at this should not be an excluded activity. If I am a free zone company, I am providing services to another free zone company, will it be qualifying income? Yes, no? Yes, no? It will be, but there are some buts which are there. First, you cannot sell to anyone who is a natural person. I am in a free zone, I cannot sell to any natural person from the free zone. B2B sole establishment is also B, but it comes into the natural person definition. If I am doing a business with a non-free zone person, then I need to look at two lists. One, it should be qualifying and it should not be exempt. Both conditions has to be looked into when you are doing a free zone to free zone activity. So if you are doing a free zone to non-free zone, there are certain activities only which are allowed to be treated as qualifying income. One, are you a manufacturer of goods? No problem. You manufacture, sell, it is considered as a free zone activity. Are you processing the goods or material? No problem. It is considered as a qualifying income. Are you trading in qualifying commodities? No problem. Holding of shares? Not a problem. Ownership management of ships, reinsurance services, fund management, wealth management, headquarter, treasury, financing, distribution, logistics, these are considered as a qualifying income. If your business is any of these category and you are providing services to another entity which may not be a free zone, no problem, you will get a benefit of a 0%. But you should not be dealing with any natural person except for conditions where the natural person has a deep pocket. Which are deep pocket business? Okay, if someone is managing ship, who can manage ship? A common person or a high net worth individual? Aircraft, that is also not a problem. Wealth management or fund management, these four income can only be provided to a natural person. Otherwise, any natural person income will take you out of the free zone benefit. One example, someone was asking me, we have a car selling company in the free zone. Correct? Car, they do a trading in cars, but they sell to natural person, those cars. The moment you bring natural person in trading activity, you lose the benefit of a free zone. This is the most important thing to be looked at. All the transactions between free zone to free zone are only exempt unless they are not included in this excluded activity. So, just a quick summary before we close the session. Any transaction between free zone to free zone, you need to look at this list. It should not be in this. Any transaction with free zone to non-free zone, you need to look at first this list. It should be included and should not be excluded in this. For free zone to free zone, one list has to be looked excluded. For free zone to non-free zone, included and excluded, both lists has to be looked at to identify whether you are getting a benefit of 0% or not. Having presence in free zone will not take you a benefit of a 0%. That's what is the most important thing. And for trading activity, only designated zone is the place where you can operate and do transactions which are qualifying free zone person benefit and should be in the designated zone only. Third port shipment is only allowed if you are in a designated zone and doing a transaction. Free zone not allowed. Third port shipment benefit you can only get in designated zone, not in any other free zone. With this, I'll close my session. Any questions?